So today we're going to touch on what is probably the most unsexy part of investment management, and that is investment process. We're approaching, again, similar circumstances that we've had in the past where the market is reaching all-time highs. Things seem to be getting overpriced. Asset prices are inflated, and the fear of missing out is starting to rage throughout the marketplace. And we get numerous questions and comments of anyone from they're completely disregarding asset price levels and chasing asset classes to higher levels, or they are, taking the extreme opposite where they're just selling to cash because they think the market's going to drop by 60-70%. And we hear both sides on a daily basis. But what it leads to is that the consistent theme where in both circumstances are probably going to, keep investors from experiencing good results is there is zero investment process. What I mean by that is you have to have a clear, concise, if not written plan on exactly how your portfolio will adjust and compensate to changing market conditions. And I don't mean speculating because we're in an expensive market and we're going to sell to cash. You can't measure that. So what are the measurable steps that you can make? So for an example, owning energy throughout the pandemic, most people think was quite unfavorable. Yes, in March, oil and gas prices were down substantially, and it has been very unfavorable for oil and gas companies. But if you had an investment process that forced you to actually add at those repressed levels back in March of 2020, you've seen 200-300% increases since that time. And so yes, in an unfavorable market for oil and gas, you would have had a multiple expansion on your investment. So without a process, you're just going to stand back and say, this doesn't make sense. I'm not going to own any of these companies. I'm not going to be in this sector. But realizing that an investment process, what it does is it keeps you from chasing markets higher and investing in depleted and unfavorable assets and allowing that recovery to happen like clockwork. It is not perfect. You're never going to time the top or the bottom effectively. But if you get it in at least the top quartile and the bottom quartile as markets shift, you're going to see a massive difference to your portfolio. And as unsexy and unsophisticated as that sounds, that will overachieve any type of speculative type of portfolio. And we've seen it with experience and results. It is not difficult to obtain a double-digit rate of return in your portfolio, regardless of market conditions, if you follow a consistent process. And it has to be rigid, and it has to be adaptable to market conditions pretty much in an instant. But you have to have the discipline and the protocol to follow that investment process to a T, because if you don't, all you're doing is speculating, which is, again, just the sister to overall speculating and chasing markets.